So my SAP screen is visible now?
Yes, sir.
Okay, fine. So in the last class actually, there was, see, in fact in the bank reconciliation process, we covered this in three customization labels or three nodes. One is create and assign business transaction. Another is define posting keys and posting rules for manual bank statement, and third one is define variants for manual bank statement. Okay, so these are the three things. Actually these two customizations are purely relating to our functionals, but the third one, this third one, define variants for manual bank statement, it is there where we can make the screen settings. So let us come to the end user screen. Accounting, financial accounting, bank, incomings, then bank statement, FF67. Okay, so this is the transaction code where we do the bank reconciliation statement. So click on FF67. Once we have already completed 1 month or first bank reconciliation statement, then each and every time we do not have to fill up the values here, that is statement number, statement date, etc., etc. Better we will go to the overview. In the overview, your company code, name of the bank, bank key, account number will be available, and if we click here, then it will show me the number of bank reconciliation statements available. As per the Indian context, normally we prepare the bank reconciliation statement once in a month, but in some companies where there is huge transactions, they may prefer to do bank reconciliation either weekly or fortnightly. Suppose this third one is the bank statement, reconciliation statement. Here the closing balance of balance is 1,40,120. Suppose we have to do the fourth bank reconciliation statement, then automatically this closing balance will be taken as the opening balance. So manually we do not have to do anything. Again I am coming to this screen. In FF67, just after your completion of the first bank reconciliation statement, you don't have to each time enter it manually, like statement number 2, date, opening balance, closing balance, you don't have to do. Just click on the overview, then click on your company code and put the cursor in last bank reconciliation statement and click on the new statement. Once you click on the new statement, then automatically the statement number will change. Instead last statement was 3, so it was automatically 4. The date is also coming automatically, but we have to change the date because we know that bank reconciliation statement is prepared periodically. Opening balance is automatically coming. How it is coming? Because the previous closing balance is automatically taken as opening balance. Suppose I am putting some certain value. I am not doing any bank reconciliation, I am putting certain values, then I click on enter. See how this screen looks like. After this transaction column there is a gap, value, date and amount, there is a big gap, then document number. So which is responsible for this kinds of settings? Only thing is, this is the transaction code where all these kinds of settings, screen settings, page setup, all these things has to be done. So click here. This is 7200 is our variant. Click on the 7200. See, there are four fields: transaction, value date, amount, document number. So transaction, here there are, this is the column 1, this is the column 2, column 3, column 4. So here is also in the same way. Transaction is the column 1, value date column 2, amount is the column 3 and document number is the column 4. But the thing is, it is not showing appropriately and there are gaps. Why there are gaps? How to solve it? Let us do that. Let us first make an analysis of the logical analysis of the things, because whatever I teach you today, I understand it after say 3-4 years of my learning. Maybe after 3 or 4 years of my learning I could able to do, very rarely you will get any help regarding this matter. Here there are, apart from column, there are two columns, offset and length. In the length column you have to decide what is the length of your transaction. Okay, so 4 means either alphabetic or alphanumeric, alphabetic, numeric or alphanumeric. So let us see in the transaction, what about hours? Hours is 4 digits, 7 to IN. But sometimes people may create it 2 digit or whatever may be. So accordingly they have to decide in this length what will be the length, what will be the maximum length, right? If the length is something more, then there is no harm. But if the length is less, suppose our length is 4, if we put it as 3, then what happens? One of the things will be hide in the system itself. Okay, it will not be accommodated in the system. Here it will not be accommodated. See, here it will be not be. See how many digits are there? 4 digits are there. I can make it 3, no doubt, but it will not accommodate here. So that's why I make it 4. If it is not 4, then you have to convert it into 4. Then after 4, this column is for offset. What is the meaning of offset? See, every column, this column and this column, there is a gap. That gap is also, see, even if there is no, see, here is also there is no gap. Okay, it looks to be no gap, but technically we should provide a gap so that these two seats are prominently looked as separate. So how to do that? For doing that, if we put it the length 4, then offset I am making 5. 5 means I am adding only a single one. Then come to the second. The second one is value date. Value date means there is a date. So that date I put it 10. Length is 10. Value date means that is there is a date of the bank transaction. So in the value date, how many digits are there? 10 is there. Suppose I am putting a date here, suppose today's date. So how many space are there? 1, 2. This dot is also has to be accommodated. 3, 4, 5, 6, 7, 8, 9, 10. That's it. So this dot, two numbers of dot are also has to be accommodated in the screen. So that's why in the customization I have intentionally put it as 10. So after 10, so this is 5. That means first column is 4 digit 4 alphanumeric length, then offset is 5, then 5 plus 10 is equal to 15. So the offset is 16. So once the offset is 16, see, once the offset is 16, it is not looking like anything having a problem. So let us come here. See, this is 4. After this 4, there is a long gap here, 16. So as there is a long gap here, 16. So what happens? The first column and second column, there is a long gap. So as there is a long gap, so transaction and value date, it is showing a long gap here between the first column and second column. How to reduce that gap? If I want to reduce the gap, then what I can do, suppose I put it here, this is 4 actually, length is 4, I am making the offset 5, then suppose I start it with 6, then 6 plus 10 is equal to 16, I make it 17. 17 plus 10, 27, I am making it say 28. Let us see. Okay, it is not showing the sequence field. First column it is showing the offset. Okay, it's all right. This is, I have to just adjust it. I am just coming out and again doing it. Okay, so this was the offset actually. This is the length number of length is equal to 4, offset is equal to 5. Then second column, it is started with 10 10 plus 4 14. It is started with 5, then it is 10 15. I am starting it with say 16. Then I am starting it with 16 plus 10 26. I am starting with 27. After 27, this is I am putting 6. So 27 plus 6 is equal to 33, but here it is 50. So what I can do, I can make it, say, suppose I make it 9. Let us see. 9 is also not accepting. Let us have 5. No, 5 is also not accepting. This is the second column, the offset is having a problem. 27, I can put it 28. 28 plus 10 38. I can make it 39. Let us see, the gap will be reduced now. Okay, save it. Once I save it, then let us just come out from here. Again I am coming to enter. Okay, this particular gap has been lost. This is minimized, but transaction and value date, there is a gap. Let us reduce the gap. Again I am going transaction and value date. The first one is transaction, second one is value date. So this is 4, because here there is a big gap. 4 plus 4, it is taking us at the offset. 4 plus 10 14. I can have here 15. 15 is accepting. Gap is reduced. Let us see. Here also I am coming back. Again I am going. Okay, then put enter. Gap is slightly reduced, but there is a gap between value date and amount. Let us see. Value date and amount, there is a gap. Yes, 15 plus 10 is equal to 25. I can make it from 26. 26 plus 10 36. I can make it 37. But first one, there is a gap. Let us see. 4. Suppose I do not put any offset. Let us see what will happen. Nothing will happen. Just click on save. The first one I am making no offset. Let us see. Let us see whether that gap is minimized. No, that gap is increasing actually. This gap is increasing. Okay, let's see. Let us have 4. Let us have offset 11. 11 plus 1 21. Let us have 22. 22 plus 6 28. Let us have 29. Let us see. I think the gap will be reduced. 22 plus 6 28. 29. 30 is also not manageable. 30 33, say. Yes, 33 is accepting. Let us see the gap. Okay, the gap is minimized actually, but still there is some gap between transaction and value date. So transaction and value date, there is a gap. 4 plus 4 8. We can start it from 9. 9 plus 10 18. 9 plus 10 19. I can put it from 20. 20 plus 10 is equal to 30. I can put it from 31. Let us save. Yes, now all the gap will be minimized. Okay, we will, I think it will be, all the gap will be minimized. Yes, all the gap will be minimized. So let us see again how all the gap is minimized. Let us click on 7200. See, the first one is 4. This is 4. I am putting the offset as 4. no gap at all, these are connected. And second one I put, see, 4 plus 4 is equal to 8, I just add 1, that is 9. Then second one, value date is equal to 10, so 10, the value date is 10, so previous 9 plus 10 is equal to 9 plus 10 is equal to 19. So I put the next one, that is 20. Then 20 plus 10, 30, I put it as 31. And last one is 6. So there was no next column, so it is accommodating. So we have to learn in that way.
Basically, it is adding one is taking care of the boundaries.
Yes, adding one is taking care of the boundaries. How to make it? So this is the length 4. Then I am making the offset here 4. That means that means exactly equal. Then 4 plus 4. Then I am adding 1 here, 9. Then 9 plus 10, 19. So here it is 20. 20 plus 10 is equal to 30. I am putting it 31. So in this manner, all the gap is reduced. Actually, these are experimentations only. This is not, so now it is looking like good. Okay, so in this way the things happens regarding the screen settings. So we can start with the asset accounting, but before going through the asset accounting, let us have a thorough discussion regarding the topic, what is there in fixed asset accounting in SAP, and what things we have to learn, what is the basic concept. So after discussing all these things, then we will dive into the asset accounting area. So this is your fixed assets accounting. Okay, actually this is not asset accounting, this is fixed asset accounting, because asset may be, there may be current asset, non-current asset, fixed asset. So this particular chapter deals with the fixed asset accounting. Rest of the things that has already been taken care in GL accounting, accounts payable, accounts receivable. So in the accounts is concerned, the rest of the things is your fixed assets accounting. Okay, so fixed assets, these are something to be used for your business enterprise. These are the these assets are purely owned by your business enterprise. Actually, we are not talking about any lease asset in this SAP. We are talking about the asset which are fully owned asset, and these assets are normally owned by the business enterprise for continuous use more than a one accounting year. Then only we call it fixed assets. And this fixed assets helps in generation of future wealth. Normally we know that our fixed assets starts with our land, building, plant and machinery, motor vehicles, furniture and fixture, and capital work in progress. So these are maybe our asset. We will discuss this types of asset. First one is land, second one is building, third one is plant and machinery, fourth one is motor vehicle, fifth one is furniture and fixtures. Okay, and furniture and fixtures, and last one is your capital work in progress. Okay, so these assets, actually we will discuss these varieties of assets in our discussion of fixed assets accounting. Now fixed asset accounting is such a topic which is based on subsidiary ledger concept, based on subsidiary ledger concept. Okay, fixed asset accounting is based on subsidiary ledger concept. So what is this subsidiary ledger concept? Let us first understand. Just a minute, let us mute it first. Padishar, just mute. Okay. This is something which is based on the subsidiary ledger concept. Okay, so subsidiary ledger concept we already discussed in through the process of our learning. We have already discussed subsidiary ledger concept in accounts payable, then in accounts receivables, and the same is also applicable with fixed assets accounting. Fixed assets accounting. Okay, so fixed asset accounting is such a topic which is based on subsidiary ledger concept. Why it is based on subsidiary ledger concept? Let us understand. What is the meaning of subsidiary ledger? Subsidiary ledger means detailed records below general ledger. Okay, below general ledger, so that is called subsidiary ledger. Like in accounts payable, there are two things. One is subsidiary ledger, and another is reconciliation ledger. Okay, so in the subsidiary ledger in accounts payable, what we treat, that is sundry creditor. Sorry, reconciliation ledger, we create a general ledger with the name of which is sundry creditor, and in the subsidiary ledger what happened, we create individual vendor master, right? So while creating individual vendor master, what are the things that is very important? The very important thing is, while creating the individual vendor master, we use or we link the GL account of sundry creditor. Okay, that is very, very important. Again, while creating the GL account of sundry creditor GL, we select in the control data tab, we select that this particular GL is subject to your reconciliation account. Let us go to the SAP and I will show you. You may be forgetting. Let us go to the FS00. I am showing it. Both the places I will show how the link is established between the subsidiary ledger and reconciliation ledger, and that is the base of all the discussions. SAP is based on this very basic concept. Normally in all accounting software these things are very vital. So let us go to the FS00, right? So in the FS00, if we go to the sundry creditor GL, this is the sundry creditor GL. If we go to the control data tab, what we have done, we use reconciliation account type vendor, right? Therefore this particular GL is such a GL which is the type of reconciliation GL. It is not an ordinary GL. See, rent payable, this is an ordinary GL. Is there anything in the reconciliation account type? No, rent payable is not a reconciliation GL, because under the rent payable we do not want creation of any subsidiary ledger. So those GL under which we need subsidiary ledger or below ledger, in that case in the same GL account creation we have to declare it that it is a reconciliation ledger. That means it is a ledger, no doubt, but the type of ledger is reconciliation ledger. And while creating this under the control data tab, we have to select the appropriate reconciliation account type. So for sundry creditor we selected vendor. Similarly for sundry debtors Sundry debtor, this GL 2 lakh 8, we select customer, D for customer. Similarly, whenever we are going to create the GL account of land, building, plant and machinery, motor vehicle, furniture and fixture, capital work in progress, definitely we will also select here, instead of customer vendor contract account, we have to select asset. Fine, we have to select reconciliation account type asset. That means the particular, see, the reconciliation ledger finds place in the balance sheet, right? Sundry creditor, sundry debtor, these are something which found place in the balance sheet. But individual vendor or individual customer, they do not found place in the balance sheet, on the face of the balance sheet. I am telling about the face of the balance sheet. So face of the balance sheet, you will found only one thing, which is sundry creditor. But below that value, there will be huge numbers of individual vendors or individual creditors. Similarly, in the face of your balance sheet, you will find building. But is there a single building? You will find a value of furniture and fixtures. But is there a single furniture in your organization, in your company code? Similarly, in the face of the balance sheet, you will found plant and machinery, a single figure, a single amount. But is there only one plant or one machine in your company code? No. So individual machines or individual furniture, individual building, individual motor vehicle, those are nothing but those are subsidiary ledgers. Okay. So whenever, that means this asset accounting deals with both the reconciliation ledger as well as the subsidiary ledger. Both things are there, and these are closely integrated. Like whenever we create the individual vendor master, we assign the sundry creditor GL there. Similarly, whenever we will create furniture, individual furniture or individual motor vehicle, there we have to link the GL account of furniture and fixture or GL account of motor vehicles, right? So that the subsidiary ledger is seamlessly linked with the reconciliation ledger. And your how the your asset accounting will be maintained in your company code, these are purely regulated. Okay, asset accounting is such a topic which is purely regulated in different countries. In India also, how you will maintain your assets, how you will show your in your books of account, these are purely regulated by accounting standards as well as income tax laws or tax laws. Because asset is something which can be manipulated for the profit, for the purpose of profit planning, for the purpose of, it can be used as a tool to evade the tax, it can be used as a tool for the benefit of the organization. So in Indian context, in other countries also, it is purely a regulatory affair, asset accounting. And in the Indian context, there is a very peculiar thing. One is, you know, every asset is subject to depreciation, and depreciation is nothing but it is the diminution in value due to use or wear and tear. And relating to the asset is concerned, our PL account is charged with the depreciation, amount of depreciation in each period. But how much depreciation will be charged to the profit and loss account for specific varieties of asset, this is different than as per Companies Act and as per the Income Tax Act. Indian context, Companies Act, as per the Companies Act, every asset will be having a life. Okay, so on the basis of life, equally the depreciation will be charged. Suppose the life of an asset is 10 years and the value scrap residual value is 10% of the book value. Suppose 1 lakh rupees is the book value of the asset. Scrap value is say 10%, that is 1000 10,000 rupees. So 90,000 is subject to depreciation throughout the life of the asset. Suppose the life is written as 10 years in the Companies Act, so 90,000 by 10, that is 9,000 every year will be charged. Okay, so this is as per the Companies Act. But in the Income Tax Act, for the calculation of taxable profit, the concept changes. That means the depreciation figure changed. In the Income Tax Act, assets are subject to depreciation on written down value method with certain percentage. So every year the amount of depreciation differs, because the depreciation will be charged on the opening balance of the last year after charge of the depreciation of that year. So the diminishing balance method depreciation and straight line method, it will never match. So what happens in Indian context, we are subject to our statutory audit for the audit of accounts as per the Companies Act. Then also we go for the audit as per the Income Tax Act for the finding out of the appropriate profit or loss as per the Income Tax Act. When we want to find out the appropriate profit, taxable profit, then the figure of profit or loss is computed as per the regulations or as per the tax concept, tax rules. So the most important change is the concept of charging depreciation in Companies Act as well as per the Income Tax Act. So similarly, we have a accounting standard 10 which tells us regarding how we will maintain our fixed assets, fixed asset accounting. And very simply, you know, up to the date of installation, whatever expenses is incurred for the asset, it is added to the cost of asset. Suppose we are purchasing a asset and we are paying carriage, we are paying installation expenses, then automatically it will be added to the purchase cost of the asset. So the total value of the asset up to the date of put to use, all the expenses, incidental expenses on the way till it is put to use, it is added with the purchase price. Okay, so these are purely regulated kind of things. So therefore in SAP they have already make sample things for the different countries. For country India also, our keeping in mind our regulatory, the sample things has been created. Okay, the basic things has been created. We will copy those things and change as per our requirement. Even if we copy, that cannot be fully appropriated for us, it will not fully appropriate for us. We have to make the changes and do the further customization, then we will carry forward. In this asset accounting chapter, before going through the asset accounting chapter, we have to learn some basic terms. These terms are entirely new to us, and if the term is also, you have also listened some terms, but the way you understand that term, that is as per the Indian context. But global context, the meaning of that term is different. Like your first class, there was a difference between company and company code. So there are some terms which are completely new in this asset accounting, so we have to make understand of that terms. The first term is called chart of depreciation. Chart of depreciation. Okay, so what is this chart of depreciation? This is the very basic and primary term in the asset accounting. I have already told you that this asset accounting is a purely regulated area. Okay, purely regulated area, because it can be used as a tool for the purpose of profit management, for the purpose of hiding the profit or showing increase in profit. observantly increase in the profit. So every country, it is a purely regulated area. So therefore, in SAP, they have created country templates. Country templates. So what is the country template? Keeping in mind the regulatory mechanism of different countries all over the world, they have created country templates for fixed asset accounting, fixed asset accounting, actually fixed assets accounting. Okay, and these country templates has been already created in the SAP system, keeping in mind the very nature or regulatory nature of the asset accounting of that country. And these country templates are called chart of depreciation. Okay, these country templates are called chart of depreciation. You will find so many country templates or so many chart of depreciation in the SAP software itself. Whenever you purchase a software for implementation of your organization, that comes with some templates. So normally not normally, 100% of the cases, maybe only one or two exceptions, or normally in 100% of the cases, all the consultants or all the organizations, they use the template. Fixed asset accounting, you are bound to use the template. After copying the template, you can make the modification, but your country template is ready. If your country template is not there, then you can also copy from another country template very similar with the Indian operation. Right now Indian country template is already there, so we don't have to worry. But sometimes also in previous version of SAP software, country template for fixed asset accounting was not available, and we have to copy it from the country template of US or UK and make certain modifications. So these are called your chart of depreciation. Then we are coming to the another term, depreciation area. Okay, so this is the second term. Let us understand what is this term. You know that as per the regulatory mechanism, your depreciation is charged in India. Depreciation is charged in two ways: Companies Act and Income Tax Act. Okay, so therefore we have to use two numbers of depreciation area for our fixed asset accounting. Sometimes for cost accounting also, another depreciation area will be used. So this is first depreciation area, this is second depreciation area, this is third depreciation area. That means from the regulatory mechanism, there are three types of depreciation area maximum. There can be three types of depreciation area maximum in an organization in India. Companies Act, you have to go by the life. Income Tax Act, you have to go by the diminishing balance method. Cost accounting, so what is cost accounting depreciation? See, you know that every organization, the reporting which is published to the outsiders, that is as per the preparation of financial statements as per the Companies Act. So the balance sheet and profit and loss account which is prepared as per the Companies Act, these are for the outsiders. These are for the different stakeholders out of the business. For example, these are meant for the registrar of companies. These are meant for your investors. Basically, these are for the use of your outsiders. Relating to the again preparation of balance sheet and profit and loss account for income tax purpose. So this is for specifically tax assessment. But also we have to prepare balance sheet and profit and loss account for cost accounting purpose. So cost accounting purpose, if we prepare a profit and loss account, is this meant for outsiders or registrar of companies or your investors? No. This is for the internal people. The people who are sitting inside the organization, they need something more than which is written in the Companies Act, which is written in the Income Tax Act. Because Companies Act and Income Tax Act, these are stereotype. We have this is purely rule based. But cost accounting, we can have different practice. Let us take an example. Suppose Companies Act, the life is 10 years. Okay, and Income Tax Act, 10% reducing balance method, WDV, is the method. But as per the cost accounting, for the charges of depreciation, your management think the life is 5 years. Okay, because your management foresee the near future. So in this case, after 5 years, suppose your management wants to discard that particular asset, because that particular asset, particular machine, after 5 years, the new version of that machine will be available. So the things which will be produced after 5 years in that machine, it will be of no use. Due to the past experience, your organization know. And your organization will be having a different planning. So within 5 years, they will charge the depreciation. So in this case, the profit and loss account will be charged different depreciation in cost accounting than income tax, than Companies Act. Similarly, suppose your company will be having the own factory, but your competitors will be taking the factory. They have got the production space through rent. So in this case, you are owning a factory, you have made the investment, but your competitors, they are managing their business through rent. So they are paying more rent than whatever depreciation you charge for your factory. So in this case, your management wants that additional notional rent has to be charged. Suppose your competitor is paying rent, say 2 lakhs in a year. Okay, but you have your own factory and the depreciation on that factory is say 1 lakh. Okay, so in this case, the expenses will be more in your competitor's case, but in your case the expenses is less, because you are charging only 1 lakh rupees as the depreciation of your factory, because your factory is owned by you. So in order to make the cost competitive, in this case the cost will be definitely low in your case, because the expenses which is charged to the profit and loss account is less. So to find out the actual cost competing with our partner, we have to charge notional rent. What is the notional rent? I am charging the notional rent 1 lakh rupees here. So once I charge the notional rent 1 lakh rupees here, where I will charge? Can I charge it in the Companies Act profit and loss account? No. Companies Act profit and loss account, I cannot charge anything which is purely hypothetical in nature. These are only the post-mortem activities, or it is purely regulated by your accounting standard. Similarly, in the income tax, no question of hypothecation. Okay, but the same thing is possible in cost accounting. In cost accounting, you can justify the things, your management can justify the things. In addition to actual depreciation of 1 lakh, your management can charge notional rent in cost accounting, and they can provide a note that this factory is owned by us and the fair rent is 2 lakh in the market. So notional rent, that is the actual depreciation, and fair rent, differential between the depreciation and fair rent in the similar locality, the differential amount of 1 lakh is charged at notional rent, right? So those things and those note is also valid in case of cost accounting when we prepare the profit and loss account to make the things competitive with our competitors. Okay, so therefore we can have three numbers of depreciation area maximum in India. One is depreciation area as per the Companies Act. So these are called actually depreciation area. So depreciation, this is first depreciation area, this is second depreciation area, and this is third depreciation area, right? So this is the meaning of the term depreciation area. And another term is there that is called depreciation methods. Depreciation methods. What are the depreciation methods? One is straight line. Straight line method. Another is say WDV, written down value method. These are the depreciation methods which are used for the purpose of calculating depreciation. Then we are coming to the third term, which is called depreciation key. Depreciation key. What is the depreciation key? The depreciation key is nothing but it is the combination of, this is the combination of rate plus method. Rate plus method. Okay, rate plus method. Rate plus method means, suppose for the straight line the rate is 10%, method is straight line, so 10% straight line, that is a depreciation key. That is a so depreciation key is nothing, this is a identification. Identification for rate plus method, because rate plus method are two things. If the two things are combined, then we have to make a identification, and that is called depreciation key, right? So nowadays in India, instead of straight line method, we are instead of any rates, we are following the life. So whatever may be, these are very much same. We are depending on the life of the asset. But income tax also, we have to create a key, depreciation key. Straight line also we will create a depreciation key, but the life will say how much depreciation is there for every year. But as per the income tax, we have to find a method as well as we have to find a rate. So 10% plus written down, that will give you a different amount of depreciation than 10% plus straight line. First year it will be same. Suppose 10% depreciation straight line plus 10% depreciation written value. The first year depreciation is same in both the cases. But second year onward, there will be a difference. Because in the straight line method, every year you calculate 10% on the book value of the asset. But in the written down value, you have to calculate the depreciation on the opening balance of last year. So opening balance of this year. That means last year balance minus depreciation. So this is the opening balance of this year. So in written down value method, the amount of depreciation reduces year by year, because the value of the asset is also reduced year by year. Okay, so that is called the depreciation key. Now we come to the next one. Next one is your posting key. In fixed asset accounting, we use two numbers of posting key. Posting key 70, that is asset debit. Then posting key 75, asset credit, right? So we learn many varieties of posting keys in the meantime. Okay, we started it with 40 and 50 initially, but up to fixed asset accounting, many posting keys we come across, and here in the asset accounting we will use another two varieties of posting key. One is 70, that is asset debit, another is 75, that is asset credit, right? Then I am coming to the another term. Another term is transaction types. So what is this transaction type? Let us understand. In fixed asset accounting, there are obviously journal entries will be there, no doubt, but there are different identification of different transactions. In fixed asset accounting, there will be different transactions, and that transaction will be called transaction key for the purpose of identification. Like transaction type 100 is nothing, these are external acquisition. Okay, so what is the meaning of external acquisition? Suppose we purchase something, we purchase a machine directly from the market and install, so that is called external acquisition of the asset. Suppose we purchase different spare parts, then assemble the machine inside of our factory, then that is called in-house production. So 110 is in-house production. Okay, so these are the different transaction types. External acquisition is 100, 110 is in-house production, 210 is the retirement of assets. Actually, the seasoned consultants or seasoned end users, they don't call the retirement of asset, they tell it 210. So from the 210, people should understand that they are meaning to retirement of asset. Suppose they are discussing about use transaction type 100. 100 means they are saying about the external acquisitions. Okay, so
Sir, here how it is different, transaction type difference from the document types?
see, in one document type, in asset accounting, we use a document type that is called AF. Actually, transaction type will not be having any number. In AF document, that means asset related document, that is a further suffix. Okay, document type is AF, no problem, but this document type is again bifurcated for generation of different reports. That is, for a particular document type, asset purchase or asset acquisition, the document type AF plus 100 is something else, and AF plus 110 tells about something else. So document type is AF, no doubt. It is plain vanilla type we understood from the 3 chapters. But in asset accounting, every document type is also judged by some more characteristics. That is, even if it is a document type AF, that is asset accounting related document like document type SA, but that is also not sufficient. We have to distinguish different varieties of transaction type inside that particular document, because asset accounting is such a subject, because in GL accounting, accounts receivable, accounts payable, normally we use, one is invoice, another is clearing or payment. Like, let us discuss about the accounts payable. In the accounts payable, KR means vendor invoice, KZ means vendor payment, KA means credit memo or debit memo, whatever like that. So these are the 3 things and everything is over. But in asset accounting, this is not plain vanilla. But lot of things are there in asset accounting. Like if we are purchasing an asset directly, it is something else. It tells about a different story. If we are producing the asset inside of our organization and capitalize the asset, it is something else. Yes, asset will be capitalized. Asset account will be debited finally, but it is a different thing. If we are selling the asset to outsiders, we are retiring the asset, getting some revenues, then it is something else. If we are scrapping the asset, it is something else. If we are transferring the asset from one department to another department, it is something else. If we are dismantling the asset and part of the asset is used in another machine, suppose we are dismantling a machine, and out of that dismantle procedures, two numbers of motors were extracted. One motor is used in another machine, another motor is used in another machine, and the rest of the things, those are sold as scrap. So lots of differentiations are there. So therefore document type is not everything, and apart from the document type, transaction type gives certain more explanation about the business transactions in addition to the document types. So this is the transaction type. Very frequently we will use it, 100, 110 and 200, so that from there we can understand the detail process, detail thing, what is the thing, what happens. Now in asset accounting, how is the data flow? Let us understand how is the data flow. So there are two things. I will make you first one is your sub asset. Okay, so just let me type it from below. This is your sub asset. After the sub asset, that will be main asset. Okay, and in the main asset we select account determination. Main asset is created with reference to asset class. So I will make you understand everything. These are the new terms, and whatever I will discuss now, whenever I will do the customization, you will realize everything. Actually, these are the theoretical things I am saying to you. So what is sub asset? Let us understand. Suppose we have a desktop. In our desktop we are using a mouse, and that mouse may be a sub asset of the entire desktop. Why sub asset? Because the main asset is your computer CPU, central processing unit, but there are some additional things which are connected to your main asset to run it. Either it is a wireless mouse or a mouse used through the wire, and the life of the main asset is also different than the sub asset. The life of the mouse may be 1 year, but the life of the CPU may be 5 years. So sub asset is something which can be used, which can be detached and can be used in any other asset. First thing, technically it will be technically having a separate existence, and the life of the sub asset and main asset is normally different. So suppose you have a machine. Every machine, normally we found a motor, AC motor or DC motor. So that AC motor or DC motor in the machine, we can call it the sub asset. And motor, in addition to capacitors, in addition to your panel board, in addition to other apparatus, cover, etc., etc., all these things, when these are combined, we call it the asset or main asset. Okay, so main asset and sub asset, there is a distinguishment. So it may happens that your main asset will be having a different life, and sub asset may be having a different life as per the Companies Act. Similarly, as per the Income Tax Act, main asset may be having a different percentage of written down value, sub asset may be having a different percentage of written down value. And the sub asset is always connected to a main asset, because in the asset register. So what is asset register? Let us understand. I have already told you that asset accounting is a purely regulatory mechanism business, and accounting standard tells Institute of Chartered Accountants of India, they have already having a guidelines or guidance how you maintain your fixed asset register, because the statutory auditors, they should be very sure that the company will be having a adequate fixed asset register maintained in your organization. Otherwise there will be a audit observations. So how the fixed asset register will looks like, what are the basic things that has to be maintained in the fixed asset register? That is the location of the asset, the value of the asset, the life of the asset, the rate of depreciation, what was the previous accumulated depreciation. So all these things are there, and the cost center which is attached to the asset, location is also there where the asset is actually used, that can be subject to verification, surprise verification. So Institute of Chartered Accountants of India and Accounting Standard also tells about how your fixed asset register looks like. So SAP is having sufficient mechanism through which you can maintain your fixed asset, whatever your regulatory mechanism says. It can be more than that also. Suppose you are purchasing an asset which is insured. So what is the company who has provided the insurance policy? What is the date of, like your motor vehicles, these are subject to insurance. So every motor vehicle, when we are creating the subsidiary ledger, there is a space for date of insurance. That means the policy last date and the premium amount, these are also there in the asset register. So asset register should show main asset as well as sub asset as well as other parameters which are required, and it is already there in SAP. Whenever we create any asset in SAP, that means subsidiary GL in SAP, it is always created under a asset class. So there can be different asset class, different asset class, okay, sorry, different asset class. So what is this asset class? Let us understand. See, you can classify your asset. See, classification of asset as per the Companies Act, Income Tax Act, that is different. That has to be mandatorily to be followed. But for your internal mechanism, you can classify your asset. For example, your building, okay, your building. The building, for the building, you can have a classification like plant building, and another is office building, right? This classification is as per your needs, as per your organizational needs, okay. So in this case, we create two numbers of asset classes, that is asset class 1. Asset class is nothing, it is identification only. Asset class 2. So we are creating two numbers of asset class. So these asset class are ultimately linked with the building, no doubt. But whenever we will create the building, subsidiary ledger of every building, in that case we have to put in which asset class that particular building lies. So in this case, we can create a report as per the asset class wise. Asset class wise report also available. So this is your asset class, and every asset class we put account determination, because asset class we do the through the asset class we do the transactions like acquisition, depreciation, sale, transfer, etc., etc. So account determination is something through which we determine the specific GL account for specific varieties of transaction pertaining to asset. I am again telling, but your realization will be perfect when I will do the customization and demonstrate the end user activity. Just understand, the name is called account determination. That means it will determine the GL account. In case of sale, the GL account is different. In case of acquisition, the GL account is different. In case of retirement, the GL accounting will be different. In case of transfer, the GL account will be different. So different GL accounts for different asset transactions, which are determined through the account determination. Okay, so these are few numbers of terms in asset accounting, and these terms will guide you in your future understanding of asset accounting. So any questions on your behalf regarding the asset accounting is concerned? Any questions regarding the basic discussions of the asset accounting?
Yes, sir. So the main asset in the sub asset,
Yes.
basically it is in mother asset and child
Child.
asset.
Yes, mother and
Right?
child.
Yeah. So basically, if you see in the motor vehicle, your motor vehicle may be the mother asset and the engine can be considered as a child.
Actually, these are purely, see, there is no regulatory mechanism for this, really. But when creating main asset and sub asset, there are different angles we create a main asset and sub asset. The first thing is, suppose the rate of depreciation is different or life is different. So in this case, it is bound that the consultant will create two numbers of things. First thing. So in a motor car, suppose we are purchasing a car, the life or the rate of depreciation is one. It is not different for the air conditioner which is there in the motor car and engine in the motor car. It is not, the regulatory doesn't say like this. So therefore, uh, first of all, we go through the rate or life. If
Okay.
if that is one, then alternative way. We arrange a alternative way. Alternative way is, suppose as per our experience, we see that a particular parts of that particular asset is normally goes for the wear and tear very fast, and it may happens that, and I am putting an another light, actually the consultant, they have to have a discussion with the management. Suppose your management will be having a very good opportunity that sometimes some parts of the asset they interchange means today they just detach that parts, use it in another machine, and from
Yeah.
another machine they detach someone and adding to this machine and they are running the machine. So in this
Right.
case also, your organization, your consultant, the implementation time, the consultant will thought of creating a sub asset for that purpose, because unless and until we will identify as a sub asset, then whenever it is detached and transferred to other department, the transaction will not be possible in SAP, because the transaction means, because that particular asset register will be having a modification. Up to this point the asset register looks like this, but after this time the asset register changes due to the interchange of that particular parts. So decision of mother asset and child asset or main asset or sub asset purely depends on the, first of all, the regulatory mechanism, that is the life or percentage, or as per the uh, system or work arrangement of that particular organization. So it depends on that.
Okay. Okay. Fine.
Any other questions regarding asset accounting?
I think nothing at the moment. Maybe little later.
Okay, okay, fine. So I think today I'm not coming. I'm not starting the customization. These are the discussions. Of late, we are discussing lots of things one by one. These are the basic concepts. I have already sent the materials, study materials, and a lot of things are also covered up to the last class. So just going through this theoretical introductions, I am just closing this today's session, and we will again meet on the next week, and we will go to directly to the customization area of fixed asset accounting. Okay, so good
So,
night.
sir,
Yeah.
can we have this Excel sheet in the photograph, because you have already made, Though you have already sent the document, is there available in this Excel template? What you have written?
you
Because
I
that is
have
the one
just
page understanding.
okay. Okay, whatever thing I have discussed now, these things are already there in the study material.
Fine, then
Okay.
it's okay.
These are exactly the same way it is found in your study material. So you can follow and make a reading of first 4 or 5 pages. Then it will be over. Then customization will be
Fine,
started. Okay.
fine.
So
Thank
good
you.
night to all of you. I am closing the session. So